Hello, my name is Bonnie Collins, a resource educator with Cornell Cooperative Extension in Oneida County. How do you decide if you want or need crop insurance? This program was made available through the USDA Risk Management Agency and the New York State Department of Agriculture and Markets through their New York Crop Insurance Educational Program. How do you think about risk? Have you had crop losses in the last 10 years? If so, if you had paid for crop insurance coverage then, would your bottom line be better today? What is your current risk management plan? Do you have money in the bank to cover your direct costs if you lose the crop before harvest? What are your cash flow needs? How much would you handle a revenue shortfall? How likely is a revenue shortfall? Do you hate these questions, especially when the next question is, would you drive a car without being insured? People used to, until laws were passed requiring insurance before you could register your car. For you as a business person trying to decide whether or not to purchase crop insurance, it's easier than you think. You can figure out on paper whether or not you'd be more profitable with crop insurance. You could look backwards and forwards. But before considering a particular kind of crop insurance policy, you should first think about how much financial risk you are willing and able to bear. Let's look at some of the possibilities for managing financial risk in the fruit and vegetable industry. There is crop insurance, written agreements, Non-Insured Assistance Program known as NAP, and the AGR-Lite, also known as Adjusted Gross Revenue. We'll look at them individually. Let's begin with crop insurance. Crop insurance was created by the USDA Risk Management Agency. It provides for private insurance companies to sell what amounts to a nationally standardized product for specific crops and also pay part of a farmer's premium. Crop insurance is available for those crops for which there is a significant acreage in production, like corn, corn silage, and soybeans. In New York State, there is no crop insurance for berries, but is available for apples, tart cherries, and peaches. Despite this, there are some crop insurance-like products, such as the written agreement, the NAP program, the AGR, and the AGR-Lite products. As you can see, apple producers received a large share of indemnity payments out of the $67 million paid out in New York State in 2012. Also note that in 2012, when the spring freezers were only an agricultural disaster, Sandy hadn't even hit until November. Let's look at written agreements for perennials. Written agreements are a crop insurance equivalent based on federal crop insurance policies that already exist in or somewhere near New York State. The process requires individual producers' approval by the USDA. For example, a producer growing blueberries could seek a written agreement that would be based on New Jersey's crop insurance policy. For perennials like blueberries, raspberries, and tree fruit like plums and sweet cherries, the deadline for signing up for a written agreement is November 20th. However, the process for a crop insurance agent actually seeking and getting USDA approval is lengthy, so it is important to approach an agent well in advance of this deadline. Let's now consider the Non-Insured Assistance Program known as NAP. NAP is purchased from your county farm service agency with deadlines parallel to crop insurance. Average market price for crop will be established by the Farm Service Agency. Beginning with the 2015 growing season, NAP will pay producers for crop losses due to natural disasters, with producers choosing coverage levels from 50 to 65% of the crop. Important to note, producers with 1 or more years of yield data can use their yields for the crop's average production history, which is needed to calculate for coverage. And producers will be charged no more than 5 3/4% of liability covered. NAP is only one of several USDA disaster programs. It is advisable to know what programs are out there and how they may or may not help your particular operation. Continually or new disaster programs were included in the new Farm Bill passed last January. They are all being administered by the USDA Farm Service Agency. For example, there is currently no NAP coverage or crop insurance for ornamental pumpkins, nor is there NAP coverage for malting barley. There is NAP coverage for ordinary grain barley in the counties where there is no crop insurance options. The Farm Service Agency has issued a 6-page generalized summary of its disaster programs. It can be obtained from the website at the link above. Adjusted Gross Revenue, AGR, and AGR-Lite Insurance Plan is a non-traditional whole farm risk management tool which uses a producer's historical Schedule F tax form or related IRS tax form as a basis to provide a level of revenue coverage for the insurance period. This insurance provides against loss of revenue due to any unavoidable natural disaster, including market fluctuation, that causes a loss in revenue during the current insurance year. Most crops are covered under the program in addition to animal production, animal products, greenhouse production, and organic production. Protection is based upon the producer's revenue and provides protection from low prices. The enrollment date is March 15th for new producers. To be eligible for the program, the producer must be a U.S. citizen, corporation, or partnership and file a U.S. tax return. The producer must provide 5 consecutive years of IRS Schedule F 1040 tax returns or similar tax documents. The maximum policy liability is $1 million. Producers who sell more than 50% of allowable income from commodities purchased for resale are not eligible for this program. Farm entities with sales of potatoes in excess of 83.35% are also not eligible to participate in this program. This is an example of a completed intended commodities report. This is a diversified farming operation that includes wholesale and retail sales of fruit, vegetables, and livestock. The value per unit for each commodity represents the expected income. This diversification formula is used to determine the number of qualifying crops. The greater the number of qualifying crops, the lower the premium rate will be. The formula is to divide 1 by the number of crops reported on the intended commodities report times 0.33 times the expected income. All crops with a total expected income greater than the results of the diversification formula is a qualifying commodity. In this example, 4 crops qualify: apples, cherries, tomatoes, and the sum of the remaining crops are grouped for the 4th crop. You can find this calculator on the RMA website. The AGR-Lite policy choices are based on diversification. There are 3 coverage levels, 65, 75, and 80%, and 2 payment rates of 75 and 80% for a total of 6 coverage level choices. Producers must have at least 3 qualifying crops in order to select the 80% coverage level, and 100% payment rate is not available. What constitutes a loss under the AGR and the AGR-Lite program? All unavoidable market and weather-related events are considered a cause of loss for this program. Hail damage, no electricity for your coolers, or rainy weathers during the spring causing a loss of retail sales. What does not constitute a loss under this program? Any type of negligence, mismanagement, or wrongdoing, and all other avoidable activities are not considered an acceptable cause of loss. This is an example of computing a guarantee and a loss payment. The producer chooses 80% coverage level and a 90% payment rate. The guarantee is computed by taking the approved adjusted gross revenue and multiplying it by the coverage rate. The product is the guarantee of $414,925. Subtracting the current year revenue from the guarantee gives us $139,925 times by the payment rate of 90%. The insurance payout is $125,933. There are several reasons where AGR and AGR-Lite make sense for many producers. This slide highlights a few of those. In summary, AGR-Lite is a whole farm revenue plan. It covers most commodities. Enrollment deadlines include January 31st for AGR and March 15th for AGR-Lite. If past the deadlines, you can still think about, if a disaster happens, what effect it could have on your profit margins. This would be the time to begin the conversation with a crop insurance agent to consider your options. How good is your risk management plan? Producers can be assured of a payday. Everyone has some kind of risk management plan, if only a thought that I can make out okay if this year's crop is flooded. If you depend on a specific level of annual income from what you grow, reviewing your crop insurance options to reduce risk of loss of income is advisable. Additional information can be found at the USDA Risk Management Agency website, including finding a crop insurance agent in your area. Also look at the New York State Department of Agriculture and Markets for additional educational fact sheets. So let's review what are the options for crop insurance when it comes to small fruit and vegetables. We discussed that some crops such as apples, green beans, and other crops are covered by crop insurance. However, those crops not covered, you should consider written agreements, AGR and AGR-Lite, and/or the Non-Insured Assistance Program known as NAP from your Farm Service Agency. Or you could hope for the best as your policy to control risks. Thank you for your time.